I'm going to talk to you guys today about an under the radar stock. Now, this stock is considered a sleeper stock. So the company, the stock itself is not asleep, but investors are sleeping on this stock. No one's really paying attention to it. But I believe in 10 plus years, holding this company now will create huge profits in the future. This is one of my newer stocks I bought within the last 6 months, and I purchased a healthy amount of it. It's a small company. It's more of a speculative play, but I'm confident this company will be much larger in the future than it is today, as it has proved itself through its last 4 earnings. And with a lot of the financial metrics I will show you, it also proves this company's on an amazing growth path. So the company is Health Equity. Its ticker symbol is HQY. And if we look here over the last 4 earnings, they beat both on earnings per share and revenue. The most recent earnings, which just were announced on September 3rd, they beat their EPS by 23%. This company has been on a tear. It's been amazing. Now, Health Equity is an American financial technology and business services company that is designated as a non-bank health savings trustee by the IRS. This designation allows Health Equity to be the custodian of health savings accounts, regardless of which financial institution the funds are deposited with. And it's these health savings accounts that I'm very bullish on. This is the one product I think is going to propel this company into a massive giant company someday. Not only that, but Health Equity is the #1 health savings account administrator, so it holds the large market share. That is the competitive advantage, that wide moat. That's what I look for when I invest in companies. Now, they have other products like health reimbursement arrangements, flexible spending accounts, and health incentive accounts. And they just released a new product I will talk about in a minute. There's another thing I love about this company. Good companies often will provide its customers with new products and services, and that's what this company is doing. So let's start with looking at what the recent earnings produced, and we're going to start with revenue. And revenue came in at $299.9 million, which is an increase of 23% from a year ago. That is fast growth. 23%, that is what you want to see when you invest in a company and expect high growth. Also, with net income, you'll see here that it came in at $35.8 million compared to $10.6 million a year ago. That is a 237.7% increase. That is massive. Not only that, but if you look at this here, I keep track of the numbers each quarter. They swung from a net loss of $14 million now to a net income of $35.8 million. That's impressive. This is exactly why I bought this stock. They are proving that they're accelerating their growth. And with this net income growing so fast, that means that the revenue they're bringing in is far outpacing the increasing expenses. Now let's look at their long-term debt. It did go up to $1.1 billion. And what this is they acquired a company, Benefit Wallet. This was an acquisition done. And this quarter, it included $225 million drawn on their line of credit in connection with that acquisition. They also are refinancing some debt, which extends maturities to 2029. So this is just going to provide them added flexibility. I'm okay with this debt for a few reasons. They acquired extra health savings accounts through this Benefit Wallet acquisition, which is going to allow them to expand their moat and make more money off of a larger customer base. Also, with $1.1 billion in debt, that is virtually the same amount of revenue made in the trailing 12 months. So if they wanted to, they could pay off debt in a year. So this is why this debt is not a big deal to me. You think of this $1.1 billion compared to a company like AT&T with near $130 billion. That shows you kind of the range of some companies that are hammered with debt compared to a company like this, which yes, it's probably higher debt than I would like, but it's still manageable and something I think they will focus on keeping under control in the future. So now I want to talk about their health savings accounts, which came in at 9.4 million. That's how many accounts they had, which is an increase of 15% year over year. We want to see this in the double-digit range. That's what it's doing. I think last earnings, it was a 12% growth year over year. So the fact that it's now 15 is awesome. And then on top of that, the HSA assets, so the cash and the investments that are held in those accounts, are at 29.5 billion, which is an increase of 27% compared to a year ago. That is very fast growth. And why I like to see this, when it's a savings account and you put money in there, you are less likely to pull out that money. You want to keep it there, right? You want to save it. And with investing, that is even more so of a sticky situation where investors won't touch that money. So speaking of investing, of those 9.4 million health savings accounts, 711,000 of those had investments, which is an increase of 24% year over year. So this is amazing to me. Just think of this. When people invest, it's for the long term. Plus, these accounts have the opportunity to use that money for retirement once you reach a certain age. So there's a lot of incentives to keep your money in these accounts, which allows this company to collect more and more fees month after month. And it creates a beautiful situation for this company's profits in the future. And I love this about it. So I will say that with these HSAs, part of the growth is from that benefit wallet acquisition, but they've done it, I think they split it up into thirds. So over the last 3 quarters, they kind of took a third of the accounts and then they applied more. And then this quarter is when they kind of closed out and finalized moving all the accounts to health equity. So it's going to be important to look at the future quarters without this acquisition to see how this company grows. But I still think it's going to be at a very fast rate. I think HSAs are in wide adoption and becoming more and more popular. Now, President and CEO John Kessler said, momentum in both the top line growth and margin expansion allows us to raise guidance. Those are gold to investors' ears. When a company raises guidance, that is an extremely good sign. That means they're expecting better than expected growth, as well as he said that they plan to accelerate their platform investments. That's creating more fees that they get to collect and giving customers more options and opportunities to want to keep their money with health equity. On top of that, he said that they also launched a health payment account. This is the new product we're going to talk about in a little bit, but this is what good companies do. They put out more and more products. Think of Apple, all the products and services it's put out. It creates that wide moat. It creates that ecosystem, and that's what they're doing. They also announced a 300 million share repurchase authorization. Share repurchases, share buybacks are extremely important as an investor because that's the company returning profits to us. They usually do it through the stock repurchases or through dividends. So they're doing it right now through stock repurchases, maybe someday a dividend. But the company announced that its board of directors authorized a common stock repurchase program. Under the program, the company may purchase up to 300 million of its own common stock. So when a company buys its own shares, it's helping to increase the price for its stock by boosting demand, thereby creating value for all shareholders. Also, the effect that the buyback has is it reduces the number of shares outstanding on the market, which increases our ownership stake in our investment. So we own more of this company when the company buys back more of its stock. It's beautiful. Also, when a company buys back its shares, that means that it's signaling that its shares right now are at a discount, and it believes that the future growth is going to be very healthy, maybe even massive. We don't know. But this is a good sign for us. This increases my confidence in this company and in its future. Now, that new service they're providing, which is the health payment account, it offers a no interest, no fee option for employees to pursue medical care with flexible payment terms. Why this is good is because it's keeping the customers with health equity. Why would somebody want to go get out, take out a line of credit or debt with interest that they have to pay when they can do it through setting it up with payment terms with no interest and no fees? This is a very smart move, and I think it's just going to widen the customer satisfaction and boost customer retention. This is all good. Now, the company had an outlook saying that revenue and earnings are expected to increase due to the benefit wallet acquisition despite higher net interest expenses. So the acquisition is going to bring in more revenue versus the added expenses that occurred for this acquisition. That's awesome. Also, the company is on track to double its non-GAAP net income by fiscal year 2027 compared to fiscal year 2024. So over a 3-year time period, doubling its net income. That's impressive. We already saw how fast it grew. So now I think this is highly achievable. They also raised guidance for fiscal year 2025. So non-GAAP EPS was raised to a range of $2.98 to $3.14 from a range of $2.93 to $3.10. That's a decent boost. They also raised revenue ranges to $1.17 billion to $1.19 billion from a range of $1.16 billion to $1.18 billion. So a slight increase. Regardless, this is exactly what you want from a growth company. This is music to my ears. So far, it's been really good. But now that we've talked about a lot of the positives, what are some of the risks? Well, they said that service expenses are projected to account for about a third of total expenses in Q4 and Q3. So with that said, we want to make sure that they continue to control these expenses. That way it boosts that net income and really serves us investors with added growth. The other side of it is there's government legislation. Healthcare is something government focuses on heavily, so there is a small risk here. But we have been through both a Republican and Democrat term while HSAs have been in play, and nothing has occurred or been presented to make any changes or create hurdles. And these accounts are actually very beneficial to consumers for tax reasons and retirement reasons. So I think it's unlikely there would be negative development here, but it is still one to keep an eye on because you just never know. And then the last risk is if there's a decrease in popularity and choice by consumers to have HSAs, which pair with a high deductible plan. And that high deductible is something that people might focus on and might not like. But if they think outside of that, this is really a beneficial plan. In fact, I encourage you to research HSAs. It's really one of the best, savings tool out there, tax efficient. It's really good. I utilize it myself. The other thing is Health Equity, you might have heard, recently had a cyber incident. And what they said is that the company is currently going under a few class action lawsuits that are seeking unspecified damages as a result of the cybersecurity incident earlier this year, but they are going to fight these vigorously. And the amount, the potential loss hasn't been disclosed, but what I will say is it was through a outside core system of theirs, so I think they'll be able to put the liability somewhere else. We'll see. This is hopefully something that will develop in a positive way. Not much has been said at this point, but I think more will be said within the coming months throughout the end of this year. And it will hopefully boost the security of this company and put more of a focus here so that it's extremely unlikely to happen again. So it's a negative for the company, but one I think they will overcome. Now, the stock, the cost of the stock, the price, it is expensive at a PE ratio of 60. It's over 60, shall I say. But aren't all great stocks expensive? You think of Microsoft. So people usually fall into this trap where they think buying a low PE ratio will help them make money because the stock just must go up. And when you buy a high PE ratio stock, your profits, your growth is limited, and maybe even losses are in store. You need to get rid of that mindset. Microsoft, again, has been one that has been at a high PE ratio, expensive for as long as I've been investing, the last 5 years, but yet it's really had some impressive growth. And you look at a company like AT&T, which has a low PE ratio of like 11.8. Look at the performance over the last 5 years. It's down 25%. This is the trap that people get into. They think that a high PE ratio is bad, a low PE ratio is good. But there's a larger puzzle here to determine the value of a stock. For me, it's the growth in revenue, net income, free cash flow, profit margins, how it makes money. So through fees, subscriptions, is it in a growing industry, or does it have a product with high future growth expectations? Does it have a wide moat, et cetera, et cetera? There's a lot more to look at. Some of the best performing companies, again, have held high PE ratios. And in fact, with this fast growth, quarter after quarter, that shrinks the PE ratio. About a year ago, Health Equity had a PE ratio over 100, and now it's dropped to the 60 range. You'll look here from the end of last year through March, you'll see the PE ratio has been even above 200. So it's really cut that in more than half within a very short time frame, and I think that trend will continue. So look beyond a measurement and look at the big picture and all the gears that help propel a company forward. As I covered, that is exactly what's happening with Health Equity, and I'm glad I made a large investment in this company. I believe it will be the next popular savings and retirement tool, more so than a 401k someday. For that, I am in it for the long run, as long as it keeps growing fast, right? I want to keep following this company because things can happen and change, but as of now, they're on track, in my opinion, that in the next 10 years, I'll be glad I made this investment, and I should have some pretty impressive profits. Now, how does Health Equity make money? They make it through a few ways. HSA account fees. So Health Equity receives a small fee for each HSA account it manages. And then it makes money through interest. Health Equity earns interest on the cash assets in an HSA account. For example, if an HSA account has $10,000 in cash, Health Equity will invest the funds in bonds and keep the interest. Also, they make money through investment advisory fees. So Health Equity receives a portion of the investment advisory fees when an HSA account holds investments in a mutual fund. It also makes money through interchange fees. So Health Equity earns interest fees when merchants accept the debit card associated with a Health Equity HSA. And lastly, Health Equity also charges a monthly investment administration fee to invest in an HSA. We call these a toll booth company. Warren Buffett loves companies like these. They kind of just sit back and collect fees month after month. It's like a subscription. It's very dependable revenue. With Health Equity growing so much, so fast, these fees will just get more and more, bringing in more revenue for this company. I love the structure of how this company makes revenue. Then let's look at what analysts think. Right now, it's considered a buy with a 31% upside potential. It's currently in the $70 range, but it has a low of 92 and a high of 115. And just looking today, analysts have been raising the price targets from around 103 to 105, which really meets that median right there of 104.5. So yes, very positive outlook from analysts, 14 analysts. And with my portfolio, right now I'm in the green, over 25%. It's been really good this year. And you'll see Health Equity there. It's kind of been hovering, flat. Right now it's down 1%. The other day it was up 2%. But I think give it another year or two, this will be highly in the green. Once more investors catch on and see what a good company this is, the growth that's occurring, and the future prospects. So overall, if you have any questions on my portfolio, let me know. I do plan on buying more Health Equity when it's in the red like this, little by little. As I already have a pretty large stake, you'll see there in purple, it's an 8.8% allocation of my portfolio. So let me know what under the radar sleeper stocks you believe are unpopular now, but in the future will be highly sought after, just like I believe will occur for Health Equity. So thanks for watching. Subscribe for much more content, and we will see you next time on Mark Arnold's Finance.